Good morning, students. Today I want to give you an assignment for the week. Classwork will be number 6, 7, and 9 of Keystone, with homework being number 8. So let's take a look at number 8, which will be your homework assignment. And I have currently due for Friday. Okay. Alright, if you go to the audit plan, I have it highlighted here, number 8. Okay, in the case, Keystone has some issues that have come up. They want to investigate warranties. What are the regulations, the generally accepted accounting principles for extended warranties, meaning, after development over a year. And then software development cost, how are they to account for those? Can they capitalize them, or do they have to expense them? And then the other issue was, software that has lost its value, impairment, down there at the bottom. Now, I've already looked up some websites here for you to investigate this. Let me take you to the audit plan itself, and I want to correct something there before we go further. If you'll notice under the requirements, it tells you to Google the FASB, the gap statement that talks about these, and in letter B, I need you to change that because actually it's the same last two numbers as the previous one, so this should be 2.5 and not 5, okay? So if you were to look those up, you just need to get the right ones, but I have given you some websites here to use. Now what you need to do is you need to write me 3 paragraphs, one on each of one of those topics that they have there. One about the revenue recognition for extended warranties, one about the software development cost, what do you do, capitalize them or expense them, and then one about impairment of assets, what's to be done from accounting principles with that. Okay, I want you to give me the sources, so if you use these, I want you to cite those in the bottom. You can just do a copy paste. Be 3 points for each of the paragraphs and 1 point for the references. General format, 10-inch, single space. You can put a space between the paragraphs, and those are due by Friday at 11:59. Each one of these paragraphs, I want 4 sentences minimum, okay? Now, with that said, our classwork today is going to be number 6, okay? So I want to go back to test material 3. And we will have a test on that on Monday, April 20th. So put that on your calendar. Okay, is this going to go? All right. Now, I want to take you to this page. You should have looked over the PowerPoints, but I want to take you to this page from the book. Okay, and then I also want to take you to number... 6. So let's go to number 6 and read what it says. Okay. The following procedures were performed to update our understanding of the client and its environment. So they want at least 4 procedures to help the auditor understand the client and their environment of internal control. And I gave you the place where they could be found, but I've actually given you the handout where I want you to get the information from. So let's go back to the handout. And you see number 2 where it says understanding the client. I want you to write down 4 of these items, okay, under number 6. So analytical procedures would be 1. That's going to be your number crunching toward the end here. Observation and inspection of activities. Inquiries of others, and review information from external sources. So if you will, write those down under number 6. Again, you're doing interim audit work and you're getting to know the client. Okay, let's go over these one more time. Analytical procedures will be some of the financial information we'll look at later. Observe and inspect activities. Okay, you'll go out through the business and you'll kind of look and see what they're doing for the mail, for example. Okay, how do they handle that? Inquiries of others, not only management, but you may want to ask some of the administrative assistants what procedures they use for certain items, confirmations, reconciling bank statements, like I say, mail. How do they protect their assets? What do they do internally from an internal control standpoint? And reviewing information from external sources. This is where your confirmations will come in, where you'll send out a confirmation letter and get in touch with possibly appraisers of merchandise or assets. You would also confirm your accounts receivable. You're going to confirm your the bank loans and accounts payable, so that sort of thing. And just write that in there. Okay, that'll be worth about 4 points there. And then we want to go on to the next page, which is on page 3, significant risk. Now, we noticed some risk here as we went about doing that. When we were getting all this information, a couple of those is KCN has engaged in a strategy to sell to customers with higher credit risk. Now, I hope you put that in your number 2. Okay, both of these were your number 2 items, so you could have put that there. That means that they're going to accept accounts receivable for people who do not have good credit. So, what's going to happen here? What kind of risk would you have? Well, that should be easy to analyze. Customer may not pay their accounts receivable. So write that in there. And what you'll have to do is you're going to have to do an estimate here. If you remember the journal entries for accounts receivable and doing your estimate, you'll have a debit to bad debt expense, because this company probably will be, you'll probably want to follow GAAP, so you want to do the, not the direct write-off, but the allowance method. And then you'll have a credit to allowance for doubtful accounts. Whatever the dollar amount is. This is an estimate. Now, bad debt expense will go on your income statement. It's going to lower net income. That gives you the potential to, manipulate or have rainy day reserves, if you remember. So you have to be careful and watch for that. Also, allowance for doubtful accounts is going to be a contra asset account, and it goes against the asset accounts receivable. Okay, so it'll be subtracted to get your net realizable value of accounts receivable. That's how it works. Now, the other one is the officers of the company receive significant bonuses based on quarterly results. Okay, so it's based on the numbers here. Okay, how are they going to look at those numbers? And they want the highest possible. Okay, so we've in cost, if you remember, return on investment, and we talked about this. Possibility here is that you might have moral hazard. And what that means is the manager or the officer may make a decision to benefit I'm going to put themselves rather than the company. Okay. Example of that would be if they're trying to get a higher net income and they're evaluated on return on investment, which would be income divided by assets. They want to get net income as high as possible. So if it's low, or if it's not within the range that they need to get the bonus, then they might sell some stock in the company that is, or in a company that was an investment for them. This company, Keystone, may have purchased stock in, I don't know, IBM, Microsoft, Apple, and maybe the manager will sell that stock to report a gain to up the income. Of course, you have to take out taxes, but if there's no really good reason for doing that other than for him to get a bonus, then that's called moral hazard. Okay. Now, with that said, I'm going to stop the video at this point, and then I'll start another one and talk about risk. So get those two done, and we'll come back with another video and discuss risk.